Today is Friday, January 15th, 2021. I'm your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the overall economy. Well, despite the massive uncertainties that are taking place, total call option volume continues to surge at even higher records, and home refinancing applications, they've surged to new highs since the beginning of the pandemic, as part of the fear of missing out trade that we've talked about a lot. And US retail sales fell again in December. And the 10-year treasury yield posted its biggest weekly increase since June. A lot going on, everybody. The US economy is clearly backtracking as the data represents it. People are taking on expensive risk with a blindfold on, and pretty much it's the dot-com all over again, but at a much, much larger scale, as we've talked about too. The price to sales ratios for the overall stock market continues surging at all-time highs, which is how many sales a company generates relative to the market value of, in this case, the stock market, is at all-time highs. So, I mean, these are the times I would definitely think of one of Warren Buffett's thousands of quotes. And this one comes to mind, which is, you try to be greedy when others are fearful, and you try to be fearful when others are greedy. That's it, right? So Warren Buffett he knows this obviously because he's experienced countless boom and bust scenarios throughout his 90-year life. But clearly he he also sees the magic money tree, which is a fancy term for printing on what we spend on, but in terms of the federal government, right? In that context. And since the start of the new year, I think we have seen a difference in the inflows of some sectors in the economy. And most notably, this past week, the cyclical trade is designated to utilities and REITs, since they are the weakest sectors since March. And you got the SPACs, and stay-at-home tech and big tech has been pulling back despite their huge outperformance. Now, I don't know if this is a permanent shift that will lead to a serious stock market correction, but the yield curve and negative non-farm payrolls data, those things would sit on top of a bunch of other things, would definitely help support this theory. However, recent data has shown that we've seen a slight marginal convergence between temporary and permanently unemployed people, with permanent jobs, lost, ticking lower from its highs. So we will see if this is just a 1-month data lag or if it's going to be a true trend reversal signal. But the fact still remains that, about 30%, a little less than 30% of businesses that were open in 2019 are now completely shut down. And so capital markets have just gone way ahead of themselves because the Fed is completely manipulated on how society thinks of wealth and money. And a good example of this manipulation is the fact that everyone thinks the Fed prints money, and people also think, these reserves are a primary attribution to MMT, modern monetary theory, but it's not, because, like I mention all the time on this channel, a reserve is literally just an asset swap with a central bank. So they're just reallocating collateral or relocating collateral from one place of the economy to another. So you're removing potential collateral from the private sector and replacing it with assets that will not be used as collateral. It's a transfer mechanism. That's all it is. And of course, we know there is $1.6 trillion in the TGA for Janet Yellen to spend on risky assets. And there is apparently a debt ceiling for the TGA. But obviously, we haven't seen, we have seen there is no such thing as a debt ceiling, because the debt is collateralized with a stripped down version of debt, which is backed up by more debt. And we also know the root of this hazardous ongoing cycle is with taxpayer dollars, because the government doesn't do anything productive with with the tax collection No, they spend it all and ultimately becomes worthless value. Now, the Fed also claims they want to taper, like we've talked about in a past video, and they don't want to raise rates because they don't see inflation as a concern right now. But this is part of the manipulation I'm talking about here, most notably because break-even inflation expectations, they've most recently went from 2.5% to 3%, so it's only climbing with negative real yields. The Fed will continue, right? I mean, they will continue to do this for a long time. Um, for as long as it takes, that's their only mandate because that's all they can do, like Japan and Europe. I mean, the federal government has literally manipulated society into becoming over leveraged and therefore automatically exposed to a financial disaster. If you don't believe me, just take a look at the percent of GDP, like the last quarter in the US was like 125%, and household percent of GDP was 75%, and non financial corporates was around 83, 85%. And don't get me wrong, there were plenty of people and businesses and cohorts of the economy that desperately needed stimulus. And a lot of them did not get it. They did not get this stimulus because the stimulus was redirected to the wrong parts of the economy, the people that didn't need it at all. So as a result, significantly rising consumer prices and massive unemployment will continue to accelerate because the responses the federal government takes, it's just more borrowing and more spending, and it's because of them that we are witnesses to a sovereign debt bubble. Now, if we take the Phillips curve into account, and for those that do not know what it is, it's essentially an inverse relationship or a kind of trade-off between inflation and unemployment. And so we know the Fed has a dual mandate, right? Everyone knows this dual mandate, which is to promote sustainable employment and price stability, right? Those are the two, that's what makes up their dual mandate. So followers of this trade-off believe that lower unemployment rates, it relates to higher inflation, and higher unemployment associates with lower inflation. See how it's inversely related. So with this being said, wouldn't you think that's the Fed's 2% inflation target, which, by the way, is another form of manipulation on how, on how they present their inflation expectation policy, because at first it was symmetric and then it was average inflation, and now they want more, but they haven't been able to reach over 2% for years, for a decade, over a decade. But you would think as unemployment continues curling higher, inflation would too. So this is why the Phillips curve is flattened pre-COVID, because inflation targets are and have been so settled for so long. It's as simple as that. But of course, the more printed dollars that are quote unquote stimulating the economy is really just decreasing purchasing power and price discovery, and thus it is devaluing the dollar against other currencies. But anyways, there is so much to still talk about. We've only hit the head on the nail, but I'm going to end today's show by hinting out gold is the best store of value in the entire world. It is money, there is a price floor, and there is use value. Bitcoin has none of these characteristics, not even close. It's just a supply and demand system. And I have some really cool upcoming interviews with, some of the best minds in global macro. We've already had the bond king, Stephen Van Meter, come up. Hopefully he could come up again soon. And please note, I am not a financial advisor, and everything I say is for informational purposes only. Thank you, everyone, and have a great weekend.